stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Since I was born, been stacking my coin. These niggas is pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fuck like porn. These rappers is whack, they lyrics is corn. I'm getting this money, it never get born. I'm loading my strap, they calling law. Fuck around and you clap for running your jaw. If it ain't about the dollars, then it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like a crypto crash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash.
Smoking on that crippy got me cliff high. Steam pot, heat rock, slingshot. Surfing through the city while them chips rise. Hot boy, do it big time. Element with my summer bay, we booed up. Cali hit the bay, we fly MIA, we pulled up. Sipping on this drink, bitch, I know the way. We juiced up, nigga violate till it's JFK like your roof up. Coin daddy bout them chips, nigga rap snacks. Face all in a box, nigga Snapchat. Fucking with the ops to get you clapped. No cap, nigga rap.
Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Yeah. Yeah. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Since I was born, been stacking my coin. These niggas is pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fuck like porn.
This episode is brought to you by FairDesk, a crypto derivatives trading platform founded by 6 former Binance execs and 3 former Morgan Stanley architects. FairDesk is a company focused on building a platform that enables traders to profit from both rising and falling markets. Sign up today and CB will credit you up to $600 in trading funds. For more information, visit fairdesk.com, link in the description below.
Face all in a box, nigga Snapchat. Fucking with the ops to get you clapped. No cap, nigga rap.
Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash.
Yes, indeed, ladies and gents, we are doing it live. FOMC meeting, the notes coming out in about 15 minutes or so. Thanks for tuning in. Let me see who we got here. Let's do a roll call. Anything for clicks in the building. 5. He said a 50 basis rate hike, not happening. I'm with you. I don't think that's happening at all. I got an article that I want to go over with you guys that really highlights, it drives home to me like why I think In the short term, we go lower. Short to mid-term, we go lower with cryptos. This lady drives it home like so on point. I'm definitely going to go over that. Try to go over it before we go live. It may not. Actually, I'm going to do that first so we can kind of go over that before we get the numbers. We've got in the building. Thanks for tuning in. Fino here in the building. Hey, CB, what are your thoughts on compound finance? I haven't messed with them in a while. When the DeFi wave was going fire ablaze, I was definitely deep in the compound world. I don't have anything bad to say about them, but I can't give you any up-to-date opinion on it right now. Chronic Chaos said, any chance of greater than 7? Nah, I don't think so. I think they're going to go 75, 75, and then after the new year, we may see a pause or a reduction. But again, I'm going to show you an article that this lady was talking about, and she makes a very, very good point. When there's blood in the street is when we. That's very true. That's very true. I said Jerome in the house. I said Jerome in the last piece to the puzzle. You're a fool. We also got Red River here in the building. Thanks for tuning in, Red River. He said, can Powell tell the market he's going to slow rates without sounding dovish? No, he can't. That's the weird space that they painted themselves in, the corner they painted themselves into, Red River. Just the inkling, just the small evidence that they are slowing down or pausing or whatever is going to make the markets rally crazy. Okay, so this is why we may see a pop when he does, or when the market, when he does telegraph that they're slowing down or pausing, we will see a pop. I'm not negating that. What I'm saying is it's a self-inflicted wound. Okay, the market will pop, therefore the Feds will have to continue to raise rates. So that's why I think we are definitely in a quandary, a quagmire, if you want to call it. Rice TVX is in the building, my brother from another mother. He said, what's good, fam? Be sure to smash that like button. Yes, please take the time right now. Let's just go ahead and get the particulars out the way. Please take the moment right now to jump on that stage, ladies and gents, and go ahead and smack those like booties for me, please. That helps the algorithm pick up on this live stream. We got 34 people in the building right now. Let's go, let's go. T Richie said, T Rich to miss said, what's good? He's definitely going 75. Yes, I agree. My guy, Rice Jaruka Christ. Remember that name, Jaruka Christ, ladies and gentlemen. That is going to be a well-known name very soon. Vet TA, please. Seems like it's due for a push up any day now. They need to stop hiking. The economy could be terrible next year. It will be terrible next year. That's why I'm not in the short run, not confident in risk on assets like cryptos and equities. Just straight up. Kyle's in the building. Will45 in the building. Woo in the building. Shout out to everybody. I missed some people at the beginning too. Crypto Yo here in the building for sure. We got Juan de la Cruz in the building. Mr. Richie JR in the building. JMS is here as well. Thank you all for tuning in. Mr. B, I don't want to miss anyone. Thank you all for tuning in today. So let's go ahead and get right into it. We got about 8 minutes. You know, I got the stream up. Let's see where it's at. Where's my stream, ladies and gents? Right here. Okay. Got the stream rocking and rolling, ready to go. So we will, you know, tune in when it's time to hear that FOMC meeting. So look, I'm not concerned about the actual hike number or basis point. That's fine. I think that's 75 is it. We're looking at the language. We want to see what they're saying, if they're hinting at slowing down. I don't think they're going to hint at slowing down. And I think that'll be very bearish on the markets. But we will see. We will see. I think it'll be a sell-off. Potential holiday crypto sell-off thoughts. Any live trade setups? Yeah, I'll show you some live trades real quick. I'll throw some out there to you. I'll throw a bone to you guys for sure. So let's take a look quickly at the charts. All right, we are towing the line. We broke below that trend line I drew the other day. Short-term trend line. So we're literally still in this channel. Now we could see a wick up to tap out some people, or we could just go directly in one direction. you listen, no one ever knows on these types of events. So don't, anyone telling you, yeah, we're going to go up and then we're going to go down, or we're just going to straight up, or we're going to go straight down. No one ever knows, ladies and gentlemen. This is like, it's random. It's a flip of the coin. So I never give you a prediction. All I can basically tell you is where I'm positioned in the markets. And Bloodalytics, we are currently short. All right, we're short Bitcoin. As you guys can see, we went short Bitcoin yesterday, and it's been trending sideways since then. All right, so just giving you where we are. I'm not going to give you any further information because we're ready to go long, and that's all I'm going to say. All right, with Ethereum, we are short as well. Okay, we went short earlier this morning, so we're short on Ethereum, guys. We were long yesterday, but because we got tapped out our long and we went back long and trended it up, but it dropped hard this morning. So we're both, because at first we were hedged. We had a long position on Ethereum, short position on Bitcoin. Now we're both short, so kind of exposed. However, we are still in this long ass trade from a week ago in Binance with Bloodalytics. We went long, not this past Sunday, but the Sunday prior to that, October 23rd, we went long on Binance coin. So we are deep in the money on that one. So semi-hedge, if you want to call it. So those are the trade setups for us right now. GMS, Bloodalytics.com. You want to know more information on how you can join those types of trades. Minho said 75 basis point coming. I wish 50. Yeah, 75 coming. 75 coming. No, I don't, bro. No, not gonna get me. No, sir. I won't even act like I know which way we're going. I'm just ready to go whichever way the market goes. We're positioned short. Okay. Sometimes the market does give us like some setup prior to big news, but sometimes it doesn't. Last time we had a FOMC, we were in the right direction. It went up in our direction, then it turned around and went down, stopped us out, and went the other way, and we caught that wave going down as well. So it's just no telling, bro. We're heading lower now. We got about 4 minutes left until we get that info. Let's take a quick look at Forex Factory. I'm going to do a refresh really quickly. As you guys can see, 2 p.m. we have Fed, FOMC statement, and federal funds rate. Again, the rate is not to me as much of a concern. I'm more concerned about the statement that Jay Powell puts out here today. Okay, the markets are looking at 75 basis point hike, which puts us at 4%. All right, that's what we're looking for. I think we're going to get that. Again, more importantly is where and what the statement tells us. We're heading lower now with about 3 minutes to go. So what I'm going to do now is pan over to CNBC, and let's go ahead and hear what they have to say on things. Let me know if you hear an echo or not. You shouldn't, though. Okay, you guys are saying you're not hearing any sound. All right, give me a second here, guys. Give me a second. You should be hearing sound. Hold on. Let me see. Mic up. Sorry, guys. Had the wrong setup going here.
The wages are up 5% year over year.
What about now? You guys should hear now.
Inflation was 8.2% year over year. So, in fact, wages are lagging behind inflation. We're not getting a lot of wage growth given how hot the labor market is. So that's one thing. Second of all, data dependence is just a very bad idea for monetary policy. You've got to be forward-looking. If you wait until inflation falls, you'll have waited too long to stave off recession. I mean, what we are seeing here is some better news on growth. I think growth will stay positive in the fourth quarter, but we are seeing positive news in inflation. And I think the Fed will have to acknowledge that in their statement, that there's better news in inflation. The key question is whether we're going to get some indication that there'll be fewer hikes, or there may be some more hikes rather than just ongoing monetary tightening. That's really the question. It's all about the messaging, as Jim said.
Mona, what would those signals sound like to you? That perhaps the tightening phase, they're going to be a little easier on it.
Yeah, I think Jerome Powell will be clear if he does indicate that perhaps the next meeting or two will be a less aggressive rate of increases, maybe lower than the 75 basis points they've done in the last 3 meetings, plus probably what they'll do today. He'll also make it very clear that that is not necessarily followed by some sort of pause. A 50 basis point rate hike is still a very aggressive rate hike by any means. And so we are continuing to see them tightening. We are well into restrictive territory. We've seen, the 10-year, 3-month yield curve now invert for a few days. And they are continuing down this path. So I think if Jerome Powell is going to try to thread that needle, he will try to say, yes, we may go at a slower pace, but no, this does not mean a pause is ahead. And for that pause to happen, of course, we'd need to hear what all the other panelists have talked about. Inflation rolling over, forward-looking indicators of inflation rolling over, which I think we're starting to see. Yeah, the language could be clear, or it could be very, very, very subtle. Let's get to Kayla Tausche now with the Fed decision.
Tyler, a 75 basis point increase by the Federal Reserve, bringing the target range for the Fed's benchmark interest rate to 3 3/4 to 4%. The decision for a fourth consecutive 75 basis point increase was unanimous, but the statement does add a new flexibility on the pace of future rate increases. The Fed now says that it must pursue monetary policy that is, in its words, sufficiently restrictive to return inflation to its 2% target over time. The Fed now says that in determining the future path for interest rates, it will consider what it calls the cumulative tightening of monetary policy and also the lags between its monetary policy actions and their impact on inflation and overall economic activity, acknowledging that there is a lag between the actions that it's taken to date and the impact that they've had on the economy so far, raising new questions about at what point the Fed could perhaps evaluate the impact of those actions and at what point they'll be fully baked in. Back to you.
All right, Kayla, thanks very much. We appreciate that.
Yeah, let's bring in our panel as we do see stock averages pair the losses. The S&P has turned positive. It's up 15 points right now, 38.72. The Dow
we got to see what this FOMC statement is. Rice, I thought I saw Rice talk about
we're seeing
when
yields
does it come out?
The Treasury market as well. The 10-year
I think it comes out
to 4%, though just barely.
At 2:30, like
bring
you
in
said.
Our panel. Let's all bring our panel back in. Let's also add Steve Leisman, Bob Pisani, and Rick Santelli to the conversation. Steve, let's start with you and that change in language that Kayla just laid out.
Yeah, Kayla certainly highlighted the most important part right there, and it looks like there's two pieces to it. The first one here, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic developments. So the first part, the part I didn't read, is they want to make sure it's sufficiently restrictive to return policy. So that tells you maybe they have more work to do. But the idea that maybe they're taking into account lags tells you maybe they're going to go slower here. I don't think I would mistake this the pause. I think it's something that you might digest.
We're hearing
and
it
say
slower.
The Fed is aware that it's done an awful lot and doesn't feel it has to do quite as much as it had done in the past. I'm going to take a quick look while I'm talking here at what's happened to Fed fund futures, and they've come down a little bit. We'll see if that holds, but that May contract was trading at 503 for a high, for a peak funds rate. Now it's at 496. So not much of a change, but a little bit of coming off there. The market still is reading this, at least in the initial minutes after the statement came out, as believing the Fed has still considerable work that it will be doing. So maybe a slower pace, but I'm not seeing necessarily a lower peak.
Yeah, and yet it seems to be a slightly different story where equities are concerned right now, Bob Pisani. You got the Dow jumping to a 1% gain now. You got the S&P up 0.75%. The NASDAQ also moving higher, markedly higher as well. I mean, when you look at the equity markets, was it just spring-loaded for any teeny tiny sign, any little bit of hope that anything could be even the slightest bit more dovish than what we have seen previously?
Oh, this is more dovish than I think most people were expecting. I mean, when I called and said, is the Fed going to indicate any kind of pivot, any hint of anything? Not in a statement, maybe in the press release. That was the consensus. But look here, all right, Steve's right. This is not a pivot, but the committee will take into account the cumulative tightening of monetary policy. Hey, that's good enough. For the bulls that are out there. Look, we just moved 40, 50 points in the S&P 500, 300 points in the Dow easily on that. And that's close enough. Now, on the press release, in the press conference, excuse me, maybe he'll talk, more clearly coded words. He'll say two-sided risks or risks of slowing growth, something like that. But this is a fairly nice bone to throw to the bulls right now. I think the problem right now for the market is the job market's not cooperating. These JOLTS report, the ADP stronger, and people are afraid the Friday jobs report is going to be a lot stronger than expected. But look how far we've come here, guys. 3,900 on the S&P 500,
down,
35.50 just a couple of weeks ago. Dollar's a little bit lower. Two-year yields have flattened out a little bit, so it's understandable why the market has rallied. But this has really been very, very impressive right now. The problem for the market now is what else are they going to really say to get the market notably higher? We're already trading nearly 17 times forward earnings with no change in the earnings estimates of about $230 for next year. This is a lot of expectations already built into the market. But right now,
exactly. They can't say pause. It's exactly what I agree with you 100%.
Do you see it the same way? What is the bond market telling you about this language in the Fed statement?
Well, I'll tell you what, we knew it was going to either be a pause, pivot, or continue to punish, the 3 Ps. But I think they weaseled in a little bit and threw the markets a small bone. Granted, it's maybe the size of a wishbone, but I'm wrong. I didn't think they'd throw any bone. The wording as it was put forth and what I heard from Kayla and Steve, to me, sounds like they gave it a little wiggle room, which explains stocks, and the markets smelled it right. I'm always a big believer in market whispering. And if you look at a 2-year yield, it started to creep down. If you looked at the euro and the dollar index, the euro, well, it started to creep up. The dollar index started to creep down. Those are both very telltale signs that we're going to be a little less hawkish than maybe many anticipated. And I think when it comes to what the Fed's going to do, I think that anybody who discusses data dependent, I just don't agree with. I think the Fed, and just based on how their statement reads, they are looking at a spot down the road and they change what that area may be. But truly data dependent just doesn't seem to add up at this time.
Nope.
And one further point I'd like to make is that if you continue to monitor how much movement we get that is tossing some of the numbers into the next Fed meeting, whether it's Fed fund futures, which the moves are small, or the moves in the current Treasury complex where yields are moving down, it's certainly a different response to this meeting than the last several 3/4 point increases.
Mona, I want to bring you back in this conversation, get your reaction to this, not only this increase, but this change in language. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic financial developments. I know we've already heard that read, but just to say it again, because it goes back to that conversation and the point that Rick just brought up about data dependency and the fact that now you're starting to see the Fed look at this and approach this maybe in a slightly different way than we've seen it in the past, at least in terms of this statement. What does it mean? What do you think it tees us up for with that press conference in just less than 25 minutes?
It's interesting, Morgan. I think they brought up two important points that we really haven't addressed or seen addressed from the Fed in the past. The first is the cumulative part, which, if you acknowledge, they started near the zero bound earlier this year. We're now at 4% on the Fed funds rate, or close to 4%. So they've already tightened this year cumulatively close to 400 basis points. In a given year, that is pretty unprecedented. And the second part of the statement that I think, again, perhaps a nod to the bulls, or at least those that are rooting for a slower pace of rate hikes, they're acknowledging the lag impact. In reality, or the Fed funds rate, there is about a 2 to 4 quarter lag from when the Fed tightens to when we see it hit the real economy. Now, some parts of the market and economy are very interest rate sensitive, and we are seeing housing, for example, perhaps the most interest rate sensitive part of the market, already showing signs of softening, weakening, perhaps even rolling over. Rental prices, which, as we all know, shelter and rent components of CPI have been sticky, but the underlying fundamentals are telling us a different story. So it is interesting to hear, certainly, the Fed talk about in its statement that it is acknowledging that it's tightened quite a bit already, that there is a lag impact. Perhaps the next part that we may hear from Jerome Powell is they want to wait, see, and assess what that lag
She looks
impact
like Kamala
Do we
Harris,
see a softer
doesn't
labor
she?
economy? Do we see wage gains start to moderate a little bit? And
Kamala,
do we
what
see
you talking
inflation
about?
rolling over
You don't
in
know
a
nothing about.
meaningful
You don't
way?
know
I
nothing
think
about nothing,
that's
Kamala.
probably, even
Come on
whether
now.
they acknowledge it or not, that's probably what they want to wait and see before they start or continue to move at this aggressive pace. So I think it's a good sign that they are thinking about things in a more holistic way, and certainly they're thinking about moving perhaps somewhat more moderately.
Jim, I want to get your reaction to this. It sort of strikes right at the question that everybody's been asking ahead of this decision, which is under what conditions would a step down to 50 basis points be appropriate? It's worth noting that the September dot plots, they actually indicated a 75 basis point hike for this meeting today and a step down to 50. And actually, you've seen that in the last two meetings. So how much has actually really changed here, potentially?
So I think a lot has changed.
Okay.
I actually think this is pretty huge. One of the things that the Fed said is that they want to get to levels that are sufficiently above neutral. What they're communicating right now, and I think this is the big news here, is that they want to get to a point where they just stop hiking interest rates. In other words, there are many forecasters out there that would have Fed funds forecasts going up to 5, 5.5, 6, and beyond in order to get inflation down. What the Fed just told us is that they're willing to get to a level that's sufficiently above neutral and keep rates there, and then wait for inflation to start to come down. So what that really signals today to me is that this is the start of the end game, meaning that, yes, the next move in December might be 50 basis points, and we might get another 50 and then a 25, and maybe they end at 5% terminal Fed funds rate. But then they stop at that level for a period of time, and they wait for inflation to come down, because sufficiently above neutral is the key. How much of a policy rate is considered to be sufficiently above neutral? Is it a 5% policy rate? The neutral Fed funds rate is 2.5%. So at 5%, you're 250 basis points above neutral. That might be sufficient. And from a cost benefit perspective, it doesn't do as much damage to the asset markets and to the broader economy by just in mortgage market, housing, and things like that, by just
I don't
hiking
agree
rates and
with you,
hiking rates
homie.
and hiking rates in order to achieve.
All right, so I'm gonna fade
your
this back,
inflation
and we'll
goal.
just have
What
a
they
chat
wanna
and
do
talk
is let
until
these high rates
Mr.
marinate.
Jerome Powell
These
gets to the
long-term
stage.
lags are going to
At
come
which
with
point, we'll see if we have some different market reactions. But let me get back to this. I got a couple questions I starred here in the chat room, and I want to answer really quickly. Actually, let me go ahead and fade this all the way back. All right, there we go. So the questions I had starred. Let's go ahead with this one. La Lola 98 asks, what am I smoking for today? I'm actually smoking a Davidoff today, my friend. The Colorado Claro. These are really good, man. So good. Very tasty. Medium, I would say medium, full body. But closer to medium. And it does taste like a Cuban. It really does. I didn't even see the description of this. But I just, wanted to search it and have you guys see what I'm smoking today. So that's what I'm smoking, my friend. We had another question or comment that I wanted to highlight really quickly. What are you drinking? I ain't drinking nothing. That what you heard was me trading. I was entering my trades to go long on Bitcoin and I think Ethereum. So that's what that was, my friend. I'm drinking coffee. And then Brightstar said something that was very profound. He said they can't have pain in 2023. They need to renegotiate their debt in 18 months. That means next year pause and then decrease rates before they get a new interest rate. And man, I hear you. And you're probably right. The issue is when they pause, bro, we're back off to the races. And it, as you stated earlier, it wipes out all the months of efforts to calm and slow down the economy. So they're going to lose, bro. They're going to lose. There's no way to win. The Fed has painted themselves in a corner, and we just got to figure out, you know, what does that look like? What does it look like with the Federal Reserve painted in a corner? My man said Placencias. I love those. No, I haven't smoked one of those in a minute. Great sticks, though. All I hear is brr. If it wasn't true, Bitcoin would already be down to 2,700. I don't know, man. You're right. The Fed losing control of the markets does look like Bitcoin going higher, stock markets going higher. But it's just so many currents, man. So many undercurrents going this way, that way. It's very hard to assess what's going to happen here just a month from now. I heard what I needed to hear. What was that, Crypto Yo? Rethinking the dollar in the building. I haven't talked to him in a minute. He said people act surprised about monetary policy, and yet they told us weeks ago what to expect. There's no right way to taper a Ponzi. Agreed. Agreed, my friend. I agree. Thanks for tuning in, Rethinking. Go check out RTD. He's a fellow Detroiter. Does great. Focuses primarily on like traditional finance. Check him out though. Gold, silver. Good stuff over there. Red River Post said futures price in terminal effective Fed rate around 4.9 now in May of 2023. The Fed increased at how many basis points and are going long or short on your trade? Well, I'm going long just from Bloodalytics. So we got tapped out our short trades. But we're long, man. We are long. And we'll see what happens. I don't know. We'll see what happens. We went long, though. So I'm giving you that freebie. We got tapped out. It's been a rough couple of days, actually, in the Bloodalytics market starting this week, to be honest with you. Look at that. I mean, we went long, got tapped out, went short, got tapped out, went long, got tapped out, went long again, went short, and then we got tapped out. So a brutal week starting out for the week for Bloodalytics. But to be expected, to be honest with you. Oh, you don't even see my screen. To be expected, honestly. Last week was phenomenal. 57% returns last week at 3x leverage on a 4K account. You're talking about over $2,000 just last week. The week prior to that did well as well. So, hey, the market's going to take back some of that money. That you just got to pay taxes. You got to pay taxes, my friend. So, we were paying the taxes earlier in this week, but we should find some stability. As you guys see, we're going long, we're going hard, pause, and yeah, that's where we are. Long both Bitcoin, Ethereum, and we're still long Binance token. Okay, so let's see if we can make a new leg up on all three of these. And to be honest with you, if I go back over to our chart, our My 2 Satoshi chart, okay, we're back outside of this channel. If we close above here in the next 42 minutes, that's bullish. We saw, again, if we close above there, we will be taking out this previous peak. And ultimately, we want to take out this one. This is the one we want to take out. Because then that would show a move like this and then a breakout above 21,000. And then if we should see a lot of gains if we break out of 21K. So that's kind of what it is, homies. Let's see here. Dixie goes down, Bitcoin goes up. Always. Not always, but a lot of the time. Seba said the hope is that inflation would temper quite a bit between now and 23, making more feasible to pause. I keep saying 3 to 6 months of a bull run, then reality hits. I can see that scenario playing out. Default. John Hill, aka Default. Yes, for sure. I can see that. I can see that panning out that way for sure as well. And that's why I'm saying, guys, like in the short run, yeah, get it how you can, get it how you live. If you can make some money on the long side, I just don't think it's gonna last. There is no right way to end this Ponzi scheme, as RTD said, as Rethinking the Dollar said. There's no smooth landing and none of that. You can't have a smooth landing. You know, there's no way you increase rates this much. I was watching a podcast snippet last night, Patrick Bett, Value Entertainment, and they were talking about mortgage rates. And they were giving you the breakdown of if just in March compared to today, what your mortgage rates would look like buying a new home at $500K. I think at 9% or wherever we are, like 7 and some change, almost 8%. It's like $1,000, $1,500 difference a month in your payment. And they think, Valuetainment, they think we're going towards 10%. And it's true. Like, things just don't, when you're talking about like interest rates, inflation, these types of numbers, they just don't stop. You know, if you're tapering off, it's going to overshoot, okay, and then maybe taper off or come down. So we're definitely going towards 10% mortgage rates without a shadow of a doubt. At 10%, you're talking about a doubling in your, just about like 90% increase in your monthly payment on a mortgage. That if you would have bought back in March, you get what I'm saying? Like compared to if you would have bought that home back in March. We are still not seeing the side effects or the ramifications of the Federal Reserve interest rate hikes thus far. None of this has played out in the markets yet. So I think we still have some ways to go as far as pain. And it is what it is, guys. That's just my take on it. I don't think this is good long term, midterm to short term for Bitcoin and the equity markets. All right. But again, we're going long. There's your freebie for the day. We're going long on Bitcoin, Ethereum. We're already long on Binance. Been long for a week and a half. So that's a trade that's playing out really well for us. But rough week to start on Bloodalytics with the Bitcoin and Ethereum pairs, because last week we did 57%. Market has to take back some of that money. You got to understand that that's just the nature of the game. So that's why you got to trade the same size every time. Don't get overzealous. Don't get overexcited when you get big weeks like we had last week. Keep consistent. Be disciplined in your trading and keep those position sizes the same. All right, until you really get way above double or even triple your account, then you can start looking to increase. Or if you're trading by percentages, you don't have to increase. You just keep your trade sizes. In Fair Desk, you can slide your ruler over and just do 5%, 10%, whatever you want to do there. All right. So let's see what we got here with these comments here. Mr. B said, yep, 10% soon. Bought last year, barely caught in the. That's great, man. Good timing. I mean, I know you didn't know, but that was great. War could serve as a distraction. Yes, it could. Larry C says, so if interest rates are raised, that means crypto is crashing. Yes. Oh, ultimately, if they continue to raise interest rates, we haven't seen the impact of any of these interest rate hikes, to be honest with you, Larry C. So it's going to be a delayed reaction. It's going to be a delayed reaction. Dana Dane said if housing goes to 10%, now they're nowhere near finished raising rates. I hear you. Yes, this is why you got to risk manage, man. You have to. Like, Number one rule, successfully trading, risk management. Not the system, not how good the system is. That's second. That compounds and helps you grow your account. You have to stay disciplined, ladies and gentlemen. Market is setting up for a rug pull or rally when Powell speaks. I hear you. I hope not, because we just went long. Oh, God. But it's possible, man. I don't think so, because at least I think they kind of read through the minutes. So we'll see. We'll see. You know what will affect us? At the comments at the end, when the questions come out from the panel, not the panel, but the press. When he starts answering questions, that's the only deviation from the minutes that would or possibly could change our direction, to be honest with you. Not familiar with it, Juan. Sorry, don't know about that one. So that's where we are, guys. I do want to go over a couple of articles. One in particular. Let me do this one first, because I covered this in yesterday's video, right? We talked about the co-founder of MakerDAO mysteriously dying at 29 years old, found on the beach behind a hospital. What the hell is that all about? I don't know. So we came to a conclusion, right? Because he made a comment, a tweet, I think the day before. This was his tweet before he went, before he suicided himself. At least that's what the conclusion we came to. He said CIA and Mossad, and you can read it, that their elite are running some kind of trafficking, entrapment, blackmail ring out of Puerto Rico and the Caribbean islands. They are going to frame me with a laptop planted by my ex-girlfriend who was a spy. They will torture me to death. So this was his tweet, okay, on October 28th. I think a day or two later, the guy was suicided. Now, I like to be balanced, right? And the easiest conclusion, right away, say, okay, yeah, one of those agencies knocked him off. Easy. Done, right? We got our Alex Jones on, and we move on to the next. Now, here's a comment that caught my attention in yesterday's video. So in yesterday's video, my guy here, Shaman06, said, dude was psychotic and not unusual for someone with uncontrolled new onset psychosis to die accidentally during hallucination paranoia. I see it a lot in the ER. So I guess he works in the ER, and he made this comment, and I was very intrigued by this comment because, you know, I wanted him to explain further. Now, for some reason, his comment, his response, it's not showing up. It's not showing up on YouTube. It says there are 2 replies, but they are not showing it for whatever reason. You fill in the blanks, but I can show you from the email alert that I got from YouTube. So he says his tweets were increasingly odd, disorganized, paranoid. He's at the right age for schizophrenia or bipolar mania with psychosis. Common themes we see in ER every day is in psychosis. CIA, FBI, cartel chasing me, family members that are spies. My devices were planted in tracking me. Then they get hurt running from their paranoid hallucinations. Covered in briars, cut all up, run into a tree in a car trying to escape, quote unquote, go into someone's house and get shot, etc. So that was his response, which is a good response. I have to say, you know, that could be a possibility. But we could also have a possibility of the CIA injecting them with something to create hallucination. We know that that's possible as well. So it can go either way, man. Brett, what's going on, bro? Here from ATB audience. Good to check out your channel. Thank you, man. Thank you for tuning in. Hey, while I have you, Brett, go ahead. Get on that stage. All right. Need you to get on that stage. I need you to smack those like Buddhists for a brother, please. Appreciate it. Brent said coin equal Coinbase. Oh, okay, Coinbase. Coinbase to me is a losing trade, bro, because the only way I see them coming to a new source of revenue, a channel of revenue for them, is going to be through Ethereum staking and probably some ancillary services they can provide in the blockchain crypto space. But they were banking on a lot of their revenue coming from fees, and their fees are very high. However, it's a race to the bottom. They won't be able to keep garnering those types of fees from this industry because they're all racing to a bottom. We saw it happen with the equities markets. It's going to happen in cryptos. You're going to get to a point when no one is charging or very small fees on trading, and that won't be sufficient for revenue, in my opinion. So, reporter from Washington Post started off good questions last time. Gotcha. Yeah. Anything for Cliff said he knew too much. Could be a paranoid mental health breakdown. Yeah, that's what the guy was saying that commented on the channel. Very, very possible. Anything for Click said, man, that comment is a part of the CIA. I mean, hey, man, people being gang stalked. I hear you. Sure, he did it himself. I hear you. Google Drive is deleting people's personal storage of the kind. Wow, that is crazy. I do know that Google does have. You look at their terms of service, they can go in there and they do scan your things for stuff that shouldn't be on there. So if they're doing it for that while they're in there, they might as well censor you from other stuff, right? What's the rate hike, guys? I left 75 basis point, Minho. So let's see if we have the we don't have Fed chair up yet. So we'll wait for that here in a second. Let's see here. Mental health issue is real. I saw very similar things happen to my family years ago. Very true. You're right, Brett. Definitely. That's a lie. It usually happens in your early 20s, college years. He was 29 unless he had already had it. I don't know, man. Who knows, man? We'll never know. How about that? We can only assume, make these various assumptions. We'll never know. Apex said that dude got the John McAfee treatment. It's possible. It's possible. Good point. Good point, Roland. I don't know. Created MakerDAO and Balancer. Huge crypto project with massive TVL. Psychosis was not my first, though. Okay. Thought, maybe. You meant thought. Yeah, guys. So let's go ahead and get over here to the podium for Mr. Jerome. That's a black name, ain't it?
To bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
He sounded very
Thank you, and I
contradictory
look forward to your questions.
I don't understand that last little statement. Sounded like they were going to
Thank you. Colby Smith with the Financial Times.
their
On the need to slow the pace of rate increases at some point, is a downshift contingent
Double
on a string
speak,
of
man.
better
They just
inflation data
have no
specifically
clue.
between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here.
That's not bullish, guys. That is not bullish.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
I'm glad you could parse through that, but you're better than me.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
That's what I want to know.
Is inflation becoming entrenched?
Why are you holding that big black mic like that?
I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so The way I would think about that is, it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is, we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy,
or our
we need
Bloodalytics
ongoing
loan.
rate hikes to get to that level
being
of
honest with you, that's
sufficiently
not good news.
Restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there?
No.
Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining.
Not even today, just period.
I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low.
Exactly.
We all know the stories of how overheated the housing market was. Prices going up, many bidders. No conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues, but no, we do understand that's really where a very big effect of our
I think at this point, we're going to start taking the leg down for the rest of the week, I would say.
Hi, Victoria Guida with Politico.
We'll see.
I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious, to what extent you do and don't draw a signal from that? So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity there. With the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see. Vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at. I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Janelle. Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really
before he made his
the
last few
Fed's
statements
and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that
30 minutes, 33
the
minutes
problems
now.
with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that.
Now, why they gotta jam up the black man every time, people? Every time the black man gets killed first.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. They got to
go after the black man first.
It's not inverted
every damn time, ladies and gentlemen.
And also, you have to look at why things, why the
he's probably wrong, no doubt about it.
Is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So, yes, we monitor it. You're right. And that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode. We can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that. What's the level we need to get to rates. And I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Contradicted what he just said.
And just a quick follow, it looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step.
Me either, Moby.
And it's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and
Moby,
that's my job.
So. I would say so.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So, how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
I cannot stand Steve Leisman from CNBC. He is a Fed.
In theory, it was a headwind this year.
But I cannot stand that guy.
The broader context is that you have households that have these significant amounts of savings and can keep spending. even in so I think those two things do tend to weigh to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are the banks that deal with retail customers. And many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
Very good question.
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Fed Chair Jay Powell just wrapping up.
All right, guys, that is it for the Fed Chair. Jerome. Man, I tell you, I just a bunch of nothing. Basically, this is CB's face at the conclusion of that. I mean, I just don't know what to think. I'm thoroughly confused. I thought I heard what I needed to grasp from that toward the tail end. Basically, they're going to stick to those rate hikes. I don't see a pause anytime soon. And I mean, that's what we saw, reaction from the markets. Dow down currently 0.5%. It was up almost 1.5%, I think, at its peak. So you're seeing a lot of volatility. S&P down 1.1%. NASDAQ down 1.6%. Volatility, though, the VIX is down. So this is what I'm saying. Like, it's so hard to trade these markets and pick a position because they've completely perverted every signal, natural signal there is in this market. There's no way for you to know which way is up and which way is down. So, hey, man, you guys got, I don't know. I mean, from what I hear, they're going to stick with this aggressive Fed rate hike program. Would love to see what the dot plot looks like now. Red River said futures fund rate hike is now at 57% for a 50 basis point in December. I'm sure that's going to get updated like later today, by tomorrow, something. You know, I don't see that. I don't see over 50% chance that we only get a 50% a 50 basis point rate hike at this point, but we'll see. So yeah, there you have it, guys. Again, I'm just I'm thoroughly confused. You know, I don't know which way is up, which way is down. I know in the short run, I think we had lower, but you know, tomorrow going into the weekend, I'm not too sure where we'll end up. I think we had lower. My gut feeling is telling me lower, but who knows? Who knows? I want to show you guys before we get out of here, because we've been going for an hour, almost an hour. Yeah, hour and 35 minutes actually. Yikes. So I wanted to show you guys this one. Let me see where it's at, if I can find it now. I may have lost it. That would suck. Maybe it's right here. Nope, that's not it. Nope, that's not it. Dang, guys, I think I may have lost it. There was an article about see if I can find it. Here it is. Here it is, guys. Here it is. So check out this article from CNBC. Okay, crypto winter only going to get worse. This is what the co-founder of Tezos is saying, and she made some very keen, very I like these remarks because it rings with me and what my thesis is in regards to cryptos in the short run. She said, quote unquote, easy money from venture capitalists, profit seeking, and low interest rates had artificially inflated the valuations of many crypto firms. And she's talking about firms, but that translates over to, in my opinion, the actual tokens as well. Even if the Fed pauses rate hikes, she said, next year, only the small minority of crypto applications that are truly useful and can organically grow users will thrive. She goes on to say a lot of this was inflated on cheap money, and a lot of this was backed by basically like VCs trying to pump. She goes on to say that the NFT, this is an example here, the NFT marketplace OpenSea, where trading volume plunged from 2.9 billion in September to only 349 million this September. All right, clearly there is a phenomenon that has kind of crested and going away in a lot of these markets, but meanwhile they're saddled with $13 billion valuations. So she's talking about more so these crypto companies, but that ultimately translates over into the coins that we speculate on. So I see, in my opinion, some headwinds here. Dry powder is a necessary thing to have, so you can take advantage of lower prices, in my opinion. That's just my 2 satoshis on it. Let's see here. Red River said, just shows that the market doesn't have a direction right now with December rate hike. Gotta run. Peace. All right, bro. Thanks for tuning in, Red River. Thanks for dropping those facts as they were coming across the wire. Malik said, until something breaks, a black swan will make them pause. Yeah, you're right. But I mean, with the black swan, that still makes us, a black swan is ultra bearish for the market. So a pause would really be washed out. It wouldn't have any effect, in my opinion. I do want to just highlight some of these comments here. Bright Star said here, we have a lot of firsts coming. I don't know what he means by that, but I will tell you it's more risky now to not be in the market than to be. Yeah. I mean, you look at history. Yeah, history always shows you it's more risky to be out because, to be honest with you, if you're not actually trading, to be out the market, you have to be right twice. You have to be right when you get out and right when you get back in. It's very hard to time. We're starting to be in a divergent market. The Dow and the Nasdaq hasn't been as correlated. Well, remember, SIBA, I don't know if SIBA's still here, but remember what company just dropped out of the Dow? I believe it was Twitter. I believe, or there was another company. I can't. No, it wasn't Twitter. It was an oil company. They booted from the Dow, replaced it with some other company. So I don't know. We'll see. But I mean, that's it, man. We went way longer than I expected. I had some other articles to go over, but I don't want to keep you guys too much longer. Make sure you guys smack those like booties for me. Get up on that stage and show CBTV some love. And yeah, I'll see you guys on the next one. My two Satoshis tomorrow. Get back to our regularly scheduled live streams. I got a couple of Trek streams to put up as well. I've got the interview with the lady from Orlando. She's a blockchain attorney, lawyer. On point. Look out for that as well. That's coming up for my YouTube members first. Try to do that later tonight, actually. Other than that, man, that is it, ladies and gents. Again, thanks for tuning in. Hit that subscribe, share this video. I'm out of here. Holla!
I'm loading my strap, they calling law. Fuck around on your tap, for running your job. If it ain't about the dollars, then it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like the crypto crash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash.
Smoking on that crippy got me cliff high. Steam pie.
Do it live! I'll write it and we'll do it live!
Okay. Ready?
Fucking thing sucks! We'll do it live.
Okay.